really need to hit the ground running on this style of investing, which is sweeping the entire world. This panel is the courtesy of BuzzOnEarth and YES BANK. BuzzOnEarth is a leading hub dedicated to mainstreaming sustainability and positioning sustainability edge as the new growth imperative for all stakeholders. That includes hundreds of startups in sustainability innovation, large businesses, and local and state governments. This knowledge series is part of an ongoing partnership between YES BANK and BuzzOnEarth on responsible financing standards and practices. 2020 has been a record year for inflows into ESG funds. Demand for ESG investments has shown no signs of abating. According to Bloomberg, inflows into ESG ETFs have surged this month, taking the amount received in 2020 to over $50 billion, more than double that of last year. Globally, sustainable investing assets in the 5 major markets stood at an estimated $35 trillion, illustrating how important ESG is becoming. Even more importantly, Morningstar reports that in regions like Europe, many funds are repurposing themselves as ESG, given that 45% of the incremental investments coming in are into ESG funds. The burgeoning interest in corporate and ESG and environmental, social, and governance information from investors, society, central bankers, and others has led to welcome developments in reporting frameworks, codes, rules, and practices. However, the absence of universally agreed objectives, standards, and thresholds for external ESG information disclosure means that reporting takes place against a background of uncertainty. Disclosures about ESG risks and opportunities outside the company's organizational and operational boundaries are currently inadequate. Today, what we will be discussing is not only what ESG is, what ESG should be to India, but even more importantly, what India should be doing in terms of raising the disclosure standards and raising the awareness on ESG. I am delighted to say that our panel today constitutes some of the stalwarts in the respective fields who will be able to give our participants some excellent insights into the world of ESG. We have with us Mr. Satya Tripathi, UN Assistant Secretary General, Mr. Chandru Badri Narayan, Managing Partner at eCube Investment Advisors, Mr. Shashwat Alok, Assistant Professor Finance, Indian School of Business, and I don't know if Niranjan, yes, Niranjan has joined us, Mr. Niranjan Banodkar, Group Chief Financial Officer. Each of our panelists will give a more detailed introduction to themselves. But what I will also request each panelist is to spend about 2 to 3 minutes on giving an introduction of what ESG means. And our objective here, therefore, is to get a very varied perspective from the outside in view from Mr. Satya Tripathi, from a practitioner in asset management and someone who's been involved in rankings, a corporate finance specialist, and a practitioner, i.e. CFO. So let us first start with Satya. We'll start with you, and then we'll move on to the other panelists.
Thank you, Abhay. So greetings everyone. And I know you all have very busy schedules, so thank you for joining in to share in what is a very, very significant conversation for India. I am Satya Tripathi. I'm based out of the UN headquarters in New York. I'm an Assistant Secretary General with the UN. I head the New York office of UN Environment. I also am the Secretary of something called the UN Environment Management Group, which is a General Assembly created body to bring about coherence in all matters environment pertaining to the 51 UN agencies, funds, and programs. As you know, the UN mirrors how a government works with like different ministries. So you have UNICEF for children, you have FAO for food, you have UNEP for environment, and UNDP for development. So all of them do stuff pertaining to the environment, and sometimes we may not be aligned as to what the big picture story is. So that's the work of the UN Environment Group. That's in a nutshell what I do at this time. ESG to me is very simple. I mean, of course, there are complex metrics that the experts will talk about. For me, ESG is about two things: understanding the true cost of any proposition that is made to people at large, because the world has become, over the last several decades, a basket case of private profits and public losses, because we don't understand what is the real import of a certain investment. So we somehow believe that the simple arithmetic of input versus output, I put in 10 rupees, I make 12 rupees, so that's a 20% return on investment. That's not what it is. It's far more complex than that. If you look at the sites of mines and around the world, the pieces are left behind for the people to pick, or the governments with public money. And so that's not an India story, that's around the world, but no different in India. So that's the first point I wanted to make. The second is that it's not difficult to turn the conversation around. We're at a challenging time in our environmental history of the planet. If you go back 10,000 years of human history, what happened in the last 9,900 years pales into oblivion in terms of what we have done to the planet in the last 100 years. And this is science. This is not, I'm not speculating here. And so that should frighten us, because if we have undone the planetary boundaries in a way in the last 100 years, 3 boundaries are already breached, and 2 more are in the process of being breached. And life as we understand, the roughly 8 million species that exist that we know of, live in a very fine balance called the web of life. We are just one species of those 8 million. And we have basically pretty much taken over 75% of the livable space on the planet. And this is not an arrangement that can go on. So global GDP, it might differ a little bit from one country to another, depending on how industrialized you are, is roughly 30% in the public sector, 70% in the private sector. So when we're talking about ESG, of course, the government responsibilities, regulations, and all matter. But what matters is how business behaves. Responsible business behaves responsibly, both in the social and in the environmental sense. And when it doesn't, then we don't have much of a planet to leave to the future generation. So let me stop there. And of course, I'll be around to answer more questions.
Thank you, Satya. Over to you, Chandru.
Thank you, Abhay. My name is Chandru Badrinarayanan. I'm currently managing partner at EQ Investment Advisors, a pioneering platform in India for investments and lending in ESG, sustainability, and climate change themes. Prior to EQ, I was executive director and country head for MSCI's India business between 2013 to 2019. And prior to MSCI, I was senior director at CRISIL Limited, where I spent 13 years. During my career of 33 years, I've had stints in banking, manufacturing, consumer products, sales, and journalism. So this is my brief background. As far as actually coming to the question of ESG and what it means to me, I think Satya put it beautifully on what is ESG and climate change and sustainability. I think we very often hear this phrase, "save the planet." I actually say, I think the planet can actually take care of itself. The Earth has been around for millennia before human beings as a species came around. We need to actually save the planet to save ourselves. We are an integral part of the planet. And if we don't do a thing, and that means, I as an individual have to take those steps and not actually depend upon others to do that. I have to reduce my carbon footprint. I have to actually save, so many other things, which are required. I have to eat local. I have to actually look at how else things can actually work out. Then only we can prophesize to others and to corporates and to other organizations. So it is not completely altruism. I think, there is the point of actually, saving ourselves before actually, we say save the planet. And that's what, ESG at a micro level means to me. And at a macro level, it also means ethics, cultures, values, trust, all these things, apart from what is environmentally driven. That's it for myself. Thank you, Abhay.
Thank you, Chandru. Thank you. Let's go to Shashwat. What are your views on that? Shashwat, you are on mute.
Sorry about that. Hi, I'm Shashwat. I'm a faculty in finance area at the Indian School of Business. I've been here for a little above 7.5 years. I pursue research in climate finance and on ESG in particular, and its impact on its understanding how investors respond to climate shocks and how and whether mutual funds priced in these shocks. So one of my recent work was part of the first body of work on climate finance, measuring of climate finance risk and its impact on stock markets, published in one of the top journals in finance area. More recently, I've been working and interested in something that Abhay already pointed out. The inflows into mutual funds were exponential, especially ESG mutual funds, during this year, during pandemic. And this relates to what we are trying to do. We were trying to understand when and how do investors respond to how and when do investors actually try and invest in ESG funds? What is driving investor preferences? And consistent with what we find during COVID across years, when there are big climate shocks and especially salient climate shocks, investors' flows into ESG funds increases. So when there is a Katrina, we see a surge in ESG funds. But when there are exogenous events which are not really personal to people, like BP oil spill, we don't see any change. So one implication of this study is that maybe if we make the environmental cost of doing certain kinds of business practices more salient for investors, the flows and the response of investors to ESG may increase. Personally, what ESG means to me, I would like to echo exactly what both Chandru and Satya already mentioned. It is about pursuing business with both purpose and profits. And we can't just focus on financial returns. Some of the ESG initiatives, at least early on, will be at the expense of generating higher financial returns, at least in the short term, but at the same time creating more value for society as a whole, which may not immediately translate into cash flows. Now, as Chandru pointed out, to me, ESG is very personal. It's about coexisting with nature, whether it's plants or animals. A lot of times, a lot of us claim to care about environment, but when we see a stray dog on the road, for instance, we'll throw a stone. All of those are reflection of what we care about as a society. And unless we care about the environment, the animals, the larger biodiversity that the nature has provided us, it's already becoming a privilege. Now we have resorts within green zones, and only it's costly to be able to visit those resorts. So unless we act now, it's going to be a privilege of the rich to be able to enjoy nature. And as Chandru rightly pointed out, we need to bring that out in our own personal habits. Save water while you can, eat local while you can, eat organic, and care about animals whenever you can. The pandemic has been quite harsh on animals as well. So let's do our bit, and hopefully the businesses will be motivated by what individual customers and investors do.
Thank you, Shashwat. Great perspectives. Niranjan, over to you. Niranjan, we can't hear you.
You're on mute, Niranjan.
Not yet. Can anyone else hear him?
No.
No.
Niranjan, something with the audio.
How about now?
Yes, now we can. Please go ahead.
Okay. Sorry about that. So good evening and thanks, Abhay. Good evening to all my co-panelists as well. And a good morning, good afternoon, good evening to the viewers to this particular session. Just a quick background on myself. I've been with YES Bank for close to 15 years in different roles, including heading the market risk function. I was also associated with the bank. It's driving the capital raising, including being part of the first green bond that we raised in Feb of 2015. And over the last 6 months, I've been also closely associated with the sustainability function at the bank. YES Bank has actually been in many ways a pioneer or a leader in the ESG practices from an Indian context. Like I mentioned earlier, whether it is the raising of the first green bond, we were also we kind of also raised FDs, which were the green FDs. The end use was for the purposes of green projects. And there are many other things, and I hope I'll be able to cover some of those areas during the subsequent conversations. But on the question that Abhay you raised on what does ESG mean, and my co-panelists have already well articulated that, of course, we are living in an ecosystem and an environment that obviously is threatened today. For various reasons that are man-made and caused by what we've done to it, and therefore we have to be responsible in ensuring that there is a significant course correction, and this course correction is not only at an individual level, not only at an institutional level, but it is for governments, nations, regulators to come together and drive this particular agenda. But just 2 points I wanted to add to what people like my panelists have already mentioned. In many ways, it is also questioning businesses as to how do you run businesses from a more long-term sustainable perspective. So there are values, thoughts, and concepts around greed that kind of come into play. And I think if we also are able to look beyond the immediate threat, what ESG also means is actually a significant opportunity for businesses and people to also create value out of this. So it's not only something that we have to be fearful about. Of course, it's a big threat, but actually use this to our advantage in many ways to leapfrog competition, to leapfrog at business levels or at national levels. So there's always a positive way of looking at things, and I am at least that's one part that we are trying to do in the bank through a very top-down approach coming right from the board to the CEO as to how do we kind of put this as part of our DNA of how the bank functions rather than just having some superficial kind of initiative. So maybe I will cover some of these aspects in my subsequent conversations. Thank you.
Thank you, Niranjan. I think we've got some very interesting perspectives, a very diverse perspective, across the whole spectrum and what ESG means. Having got that perspective, perhaps we should now drill down into India. Is India ready for ESG? I think that is what we would like to really discuss before we move into other perspectives. Does a requisite ecosystem exist in India on which we can build a strong foundation to make sustainability mainstream, as we have seen in Europe and some other developed countries? So my first question on this will be to Satya, who can give us a very good outside-in perspective, bringing in some of the best practices that we've seen outside of India, because ESG is clearly something that is that has to be materially very relevant. A one-size-fits-all approach will not really work, and India has a lot of peculiarities into which ESG will have to be structured for it to be truly effective. So Satya, could you please give us your perspectives on this?
Let me break it down to three parts, very brief, of course. The first is the challenge. What are we dealing with here? Is this something fashionable that I want to be a good enterprise? You know, if you go back to the early days of banking, it started as banking with a purpose, roughly 300 years, roughly 270 years. It started as community banks. You know, a community wanted to have something of a resource where they could put their savings together, and then that created community assets, and as community assets served the community, and so, you know, so then it has grown. So banking with a purpose pretty fast grew to banking without a purpose. So if you had a mortgage, you had absolutely no clue which 30 banks actually own your mortgage. You're still thinking Union Bank of India has given me a loan, but you have no idea who has that mortgage actually, who owns it. Of course, that's the back end, that's the kitchen. The same thing has happened now with much of what we do around the planet. We've lost purpose, and then that's a huge challenge, because this whole concept of, there's a famous American president in the 80s who said that there's no negotiating with the American way of life. More power to him, he was speaking for his country. But the fact of life is that it's 4% of the population that uses roughly 35% of world's resources. And that's not a sustainable model by any standards. I can say with some certainty that there are tens of millions of Americans that actually believe that it is not a sustainable model. And so when India thinks that we would get to the American way of life, actually we would need 6 more planets to get there. Because if you look at population density, the United States has 3 times the size of the land mass of India, with 1/4 of the population. So the ratio is 1:12. So certainly India would never get there. Not because it can't, because physically it is impossible. The laws of physics. So, you know, so my American friends, when they say that with a lot of enthusiasm that there's no negotiating with the American way of life, I tell them with all humility that there's no negotiating with the laws of physics either. And so that's the reality. What is happening globally now is that ice sheets, whether it's the Arctic ice sheets or the Iceland or Greenland, you know, the major ice sheets are actually melting 30 times faster than they used to in the 80s. And that's a reality. Now, we talk about global warming. The challenge for India is different from temperate parts of the world or colder parts of the world, where normally you see a temperature of 10 degrees or 15 degrees. That's the average temperature. So even if it warms up, they might still have a life. But a landmass, a subcontinent that has an average temperature in the summer of 40 degrees Celsius, every degree of increase creates existential challenge for the country. And sea level rises have now been predicted to go up by meters over the next few decades, not even the turn of the century. By 2050, people are predicting that it might even be, because what is happening is that the science is evolving. And a lot of the things that we didn't believe possible is now becoming very possible. If you take the example of the Intergovernmental Panel on Climate Change, a few years ago, they said, even at the Paris Agreement, 2015, the goal was that we should remain at 2 degrees Celsius by the turn of the century. Now, 3 years later, the IPCC came up with a revision. No, 2 degrees Celsius doesn't work anymore, because the rate at which the damage is accelerating, we need to stay at 1.5 to be a viable planet, or a viable species for that matter. You know, that's the first thing. So in that challenge, India finds itself in a peculiarly bad place. It's It's around the equator. So it's a hot place to be, globally speaking. And last but not the least, it has a 7,500 kilometer coastline. So much of our economic growth has come from cities and economic activities along our coastline, from fisheries to everything that happens in cities along the coast and all. And so we will be disproportionately impacted by climate change and the rate at which the damage is accelerating. Now, is India ready? Well, of course it is ready. But the point is that, can it do it by itself? I don't think so, because it will require hundreds of billions of dollars for India to really do the right thing. Now, of course, there's a school of thought that says that I didn't cause the trouble. Why am I picking up the bill? Now, unfortunately for us, the first part is true. Yes, we didn't. Because if you look at the carbon footprint, India's average, the per capita carbon footprint is roughly about 1.9 tons. Whereas if you look at other countries, the more developed world, some are 19 tons per capita. And the ideal footprint should be about 2.3 tons per capita. So India actually is below what is the, but of course, we are accelerating very fast with our economic growth. So we'll shoot past 2.3 pretty quickly. And the climate battle will actually be won or lost in India. That's our unfortunate destiny, that we didn't cause it, but we will have to deal with it without a doubt. Now, third, the solution. Is it possible to find those hundreds of billions? Now, if we are looking for other governments coming to our rescue, I mean, I'll be very diplomatic because I speak for all governments when I talk here. Diplomatically speaking, yes, the possibility certainly exists. But let's be factual. It was promised in 2015 that by 2020, countries of the world will put together $100 billion a year for the global south to be able to do what they need to do. 2020 has come and gone. And we are nowhere close to 100 billion. I mean, we haven't even seen a few billion every year. Forget 100 billion. We don't even have 100 billion cumulative yet. Forget 100 billion every year. And I'm talking about the Green Climate Fund, the Global Environmental Facility, the Global Investment, the GIF, and there are a few here and there. You add up everything, $40 billion cumulative. That's what it is, not more than that. And so that's the challenge. Now, can India do it? Of course it can, because there are ideas at play that can actually make a huge difference by creating virtuous partnerships, by leveraging private finance for public good, by finding the kind of, because banking is all about managing risks. So money flows into areas where you can show that the risks are managed so that the investment is viable. And sometimes when it is just the borrower and the lender, just two parties in the conversation, it's not a viable business. You want to bring back forests, it takes 15-year investments. Where is 15-year money? So that's the challenge. But if you come together, and I'll close by citing a quick example from our own work in Indonesia. We set up something called the Tropical Landscapes Finance Facility in 2016. The first investment we catalyzed there is a $350 million investment with Michelin, the tire company. And their work now is a sustainable rubber plantation that is actually a 38,000 hectare ring around a 350,000 hectare rainforest, which is still living and breathing, and this becomes the buffer. And all of it was possible by leveraging private finance. And so much so, we were able to actually raise the money at 50% of the cost at which the market was offering Michelin, just by bringing together right-minded actors and creating a distributed risk model where different actors pick up a little bit of the risk, and together it becomes a viable project. And I can report to all of you that 4 years down the line, it's a thriving landscape. And of course, there are challenges when you're trying to do something new, but it's a viable investment. And we're trying to replicate that model in different parts of the world. So it is possible, and there are huge opportunities like that in India, but the stakeholders have to come together. One actor or another actor cannot do it. So possibly there are people listening in that would like to come together, identify ideas, identify champions, strengthen the champions, their understanding of the financial ecosystem, and see, and Yes Bank has made a beginning. Indeed, they were the ones to issue the first green bonds in India, and but the market hasn't really accelerated since then, which is sad. If you look at China, China actually started after India did, and now they're issuing $500 billion of green bonds every year, or even more actually. Let me stop there.
Abhay, you're on mute.
Very, very interesting, Satya. Clearly, there is a problem, but as you say, there are solutions, but those solutions will be successful only if we are going to have a coordinated approach. And I think this is something that we have to aspire for. So shifting gears a little bit on the same question, let's go to Shashwat. Could you give us a view when we say, is India ESG ready? From a corporate finance perspective, where do you see India? Is there need for sustainability standards? Is there need for India to embrace its own accounting standards? Of course, this is asking for a lot, given that globally the SASB is working on it, but we still don't have a coordinated rule set. What would you recommend that needs to be done? And maybe your recommendations could go to the ICAI, which they could take into consideration. So maybe we could have a brief overview from you, because we have a lot to discuss moving forward.
Sure. So very briefly, let me first take a step back, and then I will come to maybe some pointed suggestions to what India can do. Is India ready? I agree with Satya. Yes, we are. We already have CSR norms. SEBI has regulated some business reporting standards, so we are getting there. Now, why I need to take a step back is to define what do we seek to achieve through these ESG disclosures. And if the hope is to impact how managers or CEO of top firms incorporate environmental and social sustainability in their own practices, what needs to happen? So the first thing that needs to happen is that investors should start caring about ESG when they invest in stocks. If that doesn't happen, there is not going to be any stock price impact. And we understand that managers are driven by incentives. If the stock prices go up as a result of their ESG norms, they would do more of it. The second is, even if investors are not aware and they are not willing to trade or buy stocks based on ESG, if the customers or significant fraction of customers or the employees care about it, then they can attract better talent and they can have higher customer market share or retention, which eventually will lead to higher profits, which managers may care about. So one of those two things have to happen. This is also in the context of an interesting question that somebody had raised in the Q&A, that can we have a top-down approach? I mean, yes, we can, and we need to have some top-down approach, but ultimately it will rely on the customers and the investors responding to caring about ESG enough, and consequently translating into what firms and managers care about. Now, as you rightly pointed out, one problem with ESG is there is SASB, there is GRI, there is IIRC, Climate Disclosure Project, a bunch of reporting frameworks around the world. Despite the request from a group of investors who manage collectively over $30 trillion in assets, the SEC in US has said that we would not have an integrated reporting standards, at least in the US. EU, thankfully, has gone a step further, and hopefully their experience will give us something to learn from and implement. So just very shortly, the problem right now is there's a variety of parameters and indicators, and there are now a lot of academics interested in this. So we are measuring ESG norms across countries. What we do observe is, even within India, there is a positive trend if you capture ESG together. The problem is that most of that increasing trend is coming from it's not a problem, but most of the increasing trend is coming from one, governance. So corporate governance is an easy fix, and most companies are able to do that. We have broadly agreed on what makes for a good corporate governance. The social aspect is also improving. Better labor practices, better labor policies, more insurance for labor, so on and so forth. What is not improving at the same rate is the focus on environment. And that is again because we really are not sure what we want to measure. So if you look at the top rating agencies, for instance, there are a bunch of parameters at business ethics. So some of them have 25 parameters of business ethics. But when it comes to biodiversity or animal welfare, at least half of them don't even capture one indicator. Even emissions, which I thought would be easy to capture, even emissions for most of the ESG rating agencies, there is no indicator which is capturing emissions. So one, we need to have a consistent set of parameters that all agree upon. The second is that maybe we need to break this down, the ESG, into environmental, social, and governance, and let the countries and investors and customers figure out what is it that they care about. Maybe in the short run, India can have a balance of social improvements. We need to create more jobs while we need to protect the environment, and some balance on environment. The more developed countries, maybe they don't want to create, or they don't need to create jobs at the same rate because they are not growing population-wise at the same rate. So they can focus more on the environment part. If we break it down into simple, easy to understand metrics, investors and customers can respond on their own. I'm generally more of a laissez-faire person. I believe that if investors and customers at large understand this, a lot of other things will automatically fall in place. And through these discussions and through maybe BuzzOnEarth, we can create that kind of awareness. So my short solution is, so one, there should not be a comprehensive ESG rating because that tends to conflate a lot of different issues. If we care about climate and social issues, the governance aspect has to be separate. So we need some easy to use parameters. The second is that there is positive trend in India, right? So we already know from a research published by Boston University using satellites that the world has become greener as compared to the 2000s, not as compared to 100 years ago, but as compared to early 2000s, the world is greener today. And 1/3 of that increase in greening is contributed by India and China alone, which came as a surprising positive shock to many observers around the world. So we can do it. All we need is to maybe raise awareness about this among the larger public at large. Now, the question is, if ESG was enough to generate higher financial returns and financial profits, then we won't even need to have this discussion on ESG, right? Because then everybody would be self-motivated to pursue ESG. The problem is maybe either the markets don't understand that ESG is a risk factor that can eliminate returns or profits in the long run. And because of that, it is being priced, not being priced in, or alternatively, we need to forego some returns for generating higher social value in terms of better climate or lower temperatures, access to better water quality. And there is a substitution, and I think we should be okay with it. Accepting lower returns in lieu of generating higher social value, and that is the lens through which we have to view at it. If we keep chasing financial returns and keep arguing that following ESG will lead to higher financial returns, that is again going down the same path. Eventually, that may come back and bite us. Maybe I'll stop here. I can go on, but
no, thanks. And I mean, I think you're right, but at the same time, I think, and I'm sure Chandru will answer that. And when I go to the next question, I think he will be probably able to refer to more points on what you made. We may not necessarily need to sacrifice returns. ESG is by itself alpha creating. And I think Chandru will give us some very good insights. And Chandru, I'll come to you in a bit. But before that, let's just complete this, going to Niranjan. What are your views? And Chandru, then I'm going to come to you on exactly the point that Shash made. Would love to have your views on alpha creation. But before that, Niranjan.
Thanks. I think couldn't agree more with what my previous colleagues actually mentioned. And the way we see this from our vantage point is within E, S, and G. I think the G, the governance, is a lot more evolved, well understood as a subject. I think there have been enough and more case studies to kind of drive home the point on G as well, right? But it's actually the benefits of the E and S in that ESG which needs a lot more understanding. So just to give you an example, when we look at let's say the various disclosure requirements or standardizations that have been issued, there is MCA which is put out a national voluntary guideline on responsible business behavior in India. Right? There is SEBI that's mandated the annual business responsibility report. Again, that covers the top 1,000 companies. They've also put out a stewardship code for investors. RBI, in their regulatory thought process, has included social infrastructure and renewable energy as part of priority sector. There is a guidance note that, let's say, a Bombay Stock Exchange has put out on ESG disclosures. The point I'm trying to drive is, if you see, most of these aspects are fragmented, right? I think what we need essentially is a uniform understanding, albeit in the Indian context, but a uniform understanding of what an E means, what an S means. And at least we've seen the benefits. I think it was also mentioned earlier by Professor Alok, is how does your investors influence the market cap of a company if you are good on your ESG practices? And we've been benefited from the fact that we got included in MSCI, we got included in the FTSE for Good Index. So there is a clear benefit. And if as important stakeholders in the community, if we keep communicating this point more emphatically with our stakeholders, and let's say for a bank, it's clearly our customers, the responsibility is also on us to kind of drive home the point. So I personally believe that each stakeholder will have to play its part, including the regulator, investors, financial institutions, corporates for themselves, because at the end of the day, we're kind of looking at a very daunting issue to deal with. And if we kind of look left, look right to figure out who is going to take the lead, we may actually end up in a bit of a mess.
Great. No, thank you. Thank you. Very good points. Let's go now to ESG investing. The concept of ESG is morphing from purely socially responsible investing and impact investing to integrated in ESG investing, i.e. the explicit integration of ESG factors in the financial analysis. So let's discuss, what opportunities does integrated ESG investing bring? And I think here I would like to have Chandru take this question, primarily, talking about this. And is ESG a source of alpha generation, or is it merely an additional lens to evaluate risk factors? And Chandru, it would be very nice if you could illustrate, your answers with some examples which are relevant in the Indian context. If you're not, if you don't want to speak on a company per se, you can probably, refer to it as an X company in an X sector. But please give us your perspectives.
Thank you, Abhay. I think, fantastic discussion on the subjects. Before, coming to the specific point, I would just like to actually, identify with what Satya mentioned about India and the billions of dollars which we require, and how there is a big mismatch in the funding. And, I can empathize with that very much, since we are setting up a climate finance institution in India. India, as Satya said, being in the equator, and traditionally you would find, quite traditionally, I would say that going back to millennia, there is a reason that, why most of the life started actually getting created around the equator, because they were ideal, temperate climate, which actually led to food production as well as more people coming on. But as the planet warms, this is creating a lot of issues. And there is a whole host of research which points out to actually wars and strife taking place as the temperature heats up. And, most of the population from the equator starts pushing upward. And that's why, it's a very, very important step to actually tackle climate change for India. Coming to your point of actually, of course, when I think the first point which you had asked was India ready? I think, I would say that as far as India is concerned, or ESG is concerned, ESG as a combined concept is not many decades old in Western countries. And I would give a lot of credit to the United Nations in kicking off the combination of E, S, and G. And corporates have always been into ESG across the world in some form or the other, and to varying degrees. But what has, however, changed is a shift in the interest of institutional investors, and read that as big money in US and Europe, to move from profit alone to profit plus purpose. this is given way to a structured framework in which ESG is being carried out, reported and analyzed across the world. Such standardizations always provide an impetus to any movement, and ESG is no exception at all in this. I would also say that from the perspective of a Western accepted framework of ESG investing, India's ecosystem is still evolving in understanding of this framework, putting systems in place required and nascent stewardship efforts, reporting, disclosures, analysis, and strategizing. However, the degrees of corporate readiness vastly differ from large cap to small caps, MNCs, private sector and public sector, and even within that from firm to firm, with the impetus coming from large investors, board, management, regulators, buyers, or consumers. Now, coming to the point which I think Shashwat mentioned and you wanted me to allude to, I would say that in my experience, ESG is more of building or adding purpose to the profit objective, while socially responsible investing and impact investing put impact first and profit next. ESG has its place, and so does SRI, socially responsible investing, and impact investing. We can take one of the SDGs, that is the Sustainable Development Goals, and build a socially responsible business around it. But a current business adopting ESG norms will mostly cover many of these SDGs, but its purpose will not be to focus on catering to a particular SDG. So it will be profit plus purpose. And from all the data available on publicly listed companies, it is very clear that firms adopting, refining, and moving up the curve on ESGs are rewarded by shareholders as these steps start resonating with shareholders and stakeholders. However, if a company only gets into a tick box or greenwashing, it soon gets caught out, and the fall is much heavier than the alpha which has been produced before. The specific data, I think, you are very well aware of this, Abhay, and probably Niranjan also, is that in India, the MSCI India ESG Index and the Nifty ESG Index have shown consistent outperformance over their standard benchmarks of MSCI India benchmark and the Nifty. Not only that, I've seen that in MSCI India ESG Index has a positive divergence over a period of 10 years over the MSCI India Index. And even during the crash of 2020, the MSCI India ESG Index outperforms its benchmark index. So we can see that ESG has been consistently and steadily producing not only alpha but more alpha. That's I would say on the market as a whole. Now, as far as individual stocks, we have enough examples of actually stocks moving up when they've taken actually positive measures on ESG. But at the same time, what I've seen is that the fall is far greater than the alpha creation when companies actually trip. And we have enough and more example, all across, right from pharma companies to maybe automobiles to financial services, etc. So I think, that's been my experience. And I would like to, as I said, separate the socially responsible and impact investing from ESG and how it differs. I hope that helps. Thank you.
Sure. No, very, very, very useful. Thank you. Niranjan, would you like to also answer this question from a practitioner's perspective? How do you see it? As Chandru mentioned, you do need to separate impact investing and ESG. So what are your views on ESG? Because I'm sure at YES Bank, in fact, at YES Bank, you all were amongst the earliest pioneers introducing ESG, talking about sustainability, coming out with sustainability reports. So what are your views on this?
Clearly, ESG, I would say mainstreaming of ESG or integrating ESG into the core work streams, has led to many good outcomes, right? And I can kind of get into specifics here. One is clearly product innovation. I mentioned a couple of examples right at the start, which was on the green bonds, but as rightly pointed out by Mr. Tripathi, clearly there is room for us to do better. But I think it at least drives the culture for innovating, and the innovation does not only stop for our products. because as we keep communicating this with our relationship managers, their ability to therefore, relay and communicate with with their customers is also important from driving the point of innovation at the company as well. So not that we are being the catalyst for that, but at least we are ensuring that we keep emphasizing on that point. I think that's the first aspect. What we've also seen is clearly, given our push to the ESG integration, we've seen a significant increase in our renewable sector exposure, and therefore we've seen our divestments in many ways from some controversial sectors. Right, it's been a function of we kind of complying with some exclusion lists. It's been a function of also just driving the greening of the portfolio concept, right? There is a lot of work to be done. I will have to be honest about it in terms of how do we now start measuring climate risk in our portfolio. How do we quantify that? There are issues around how do you, to begin with, collate information and data, which is a big challenge here. But nevertheless, I think when I look back, clearly we have been a bank where we've been able to actually move away from controversial sectors from an ESG standpoint, and in fact, we were actually a large lender into the renewable space as well. We've seen benefits on strengthening of internal processes actually as an outcome, because the moment we kind of go through the requirements of disclosure, and we've been in compliance with let's say disclosure requirements of the GRI. Including TCFD, it is at the end of the day, it means that we have to follow certain processes at the back end. So it means that we've been able to correct and improve and strengthen a lot of our internal processes, information that we relay back to the board, what outcomes they kind of provide. So, for example, the whole thought process on disclosure around materiality assessment, it's been a very important aspect in terms of what we disclose to our let's say stakeholders. Increasingly, this is not that we've triggered it, but we've seen a good engagement and increasing engagement that has come in from a lot of our investors who are now very keen to understand what we are doing on the ESG space. And to that extent, I would say it's also helping us position differently rather than just focusing on the key metrics of what your margins are, what your costs are. But as an institution, how have you been a responsible institution? And you can say nothing that you're kind of trying to say it means great in terms of market valuation, but it does add a good brand perspective to the institution as well. It also means capacity building. Clearly, you want to kind of build, engage with stakeholders, government, policymakers, regulators. You kind of get people, educate, train them. In essence, we are also trying to create that culture where people appreciate this point on what climate risk, what social risk, what environment risk all means, and what it can actually do to the credit portfolio of the bank, what it can do to investment market valuations. If you're able to drive that point well, is something that has been our objective. And there has been enough and more case studies to the point that Chandru also meant. Yes. We've seen ESG returns do better. They've been more consistent, sustainable. We've seen companies who are more predictable and sustainable are exposed to lesser tail risks. So there is a credit risk measurement there. It helps market valuation. So look, ESG integration in our view is there are clear benefits out there. But I think to the point that I made earlier, it's for everybody to come together rather than look at it in isolation.
Thank you. So the conclusion is that ESG factors are financially material, and issues such as climate risk are investment risks. So clearly there is a very fine line now between ESG factors and fundamental financial factors, because with the many disruptions that we are seeing across the world and the many changes that we expect we will have to start integrating many of these ESG factors, or else we will not be able to incorporate the risks and opportunities in all our daily lives, particularly as practitioners in corporate finance or as investment managers. Let me now move this discussion to ESG ratings, ESG rankings. There has been a lot of debate, a lot of conversation that ESG rating providers aim to give the market readily available means by which to judge and compare investee companies. In the absence of any common standard, ESG rankings are rarely uniform. There are instances where rankings on the same company differ at different rating providers. Is there an excessive reliance currently on ESG rankings, particularly in a country like India, where everyone is still coming up to speed? There is no taxonomy on what really constitutes ESG. So my first question, I think before I go to Chandru, I would like to ask this question to Satya. From a global perspective, what would you say India needs to do? Because this has been prevalent all over the world, and India is now coming up to speed. As I said, India will need to hit the ground running. What is your view on this perspective?
Well, I think the current scenario is that it captures too little. So don't ask, don't tell is in general of course, there are outliers. When I say outliers, these are champions. So there are those that really are ahead of the pack, but there are too few to be even counted seriously. So that's one. But I think, in the context of this, it is important to understand that while I mentioned earlier that India's per capita carbon footprint is perhaps less than what the ideal number is, where everybody needs to get to, but that doesn't tell the full story. There's a per capita measured against more than 50% of the people living on less than $2 a day, which is the World Bank metric for the poverty line. So there are clearly segments of industries that are heavily polluting, that have a far more significant footprint per unit of production. And now that every significant economy in the world is actually, of course, they haven't provided a pathway yet. So I remain optimistic, but skeptical, because when somebody tells me I'm going to be carbon neutral by 2060 or 2050, or which is Japan, 2060 China, 2050 is Japan, South Korea, European Union, and now most likely the United States. And then, of course, Sweden has promised 2045. And so the numbers are increasing, and that's wonderful. But I would still like to see a pathway. Because if I say I'm going to lose 30 kilos of weight in the next 10 months, then I need to have a pathway. I can't say that the first 9 months I'll do nothing and I'm going to lose 30 kilos on the 10th month. That's not going to happen. Let's look back the last 30 years of promises, promises, and promises. If you go back to 1992, when the Rio Conventions came into place, the UN Framework Convention on Climate Change, the Biodiversity Convention, and the Convention against desertification, So have we achieved much? We have talked about it a lot. We've achieved precious little. I mean, you can, in absolute terms, maybe a lot, but precious little in terms of turning the tide on climate change, on environmental degradation. So I think that's what is crucial to understand, that I was recently speaking at a summit of CEOs, and my point to them was that look at it from the perspective of a parent. You have children, you have people depending on you, and the society is depending on you, and everything you do is around something called risk, how you manage risk. Your ideas, your imagination, your advanced planning, everything's around risk. For God's sake, how do you not see the climate risk for what it is, and how it is accelerating, and how it will undo everything in terms of business continuity that we have in mind? So yes, a lot needs to be done in India and elsewhere about ESG, But the fact remains that it's not a choice we make. We missed that bus a long time ago.
Very true.
We really need to do what we need to do. We need to wake up and smell the coffee. Otherwise, countries like India will pay a heavy, heavy price. And nobody comes to your rescue. If you are looking for friends in the global arena that they will come to your rescue, they don't. Look at, there are enough examples around the world to look at. So we have to take care of ourselves. And I speak that as a proud Indian. We really need to understand that our future is at stake, not just the future of certain businesses, but the future of Indians. And when you talk of future of 1.4 billion Indians, you're technically talking about the future of humanity itself. And as was rightly pointed out, that this is not about the planet. Let's stop pretending. Let's be very selfish. The recent report of the Intergovernmental Panel on Biodiversity tells us that actually there are 1.7 million viruses that we haven't even figured out. And we are, the entire system as we know it has been upended by one COVID-19 virus. In the last 30 years, 75% of the new diseases are where pathogens have jumped from animals to humans, because we are cohabiting in their space or taken over their space by squeezing them into a very restricted space where they live with each other, where in the past these species didn't live with each other. So we've created those conditions. We really need to see the existential risk for us as a species, as humans, in a very selfish way. Not being, this grand conversation about, let's save Mother Nature, let's save planet Earth. We don't need to do that. Let's save ourselves. Thank you.
Thank you, Satya. Thank you. That's very, very interesting. Clearly, I think we are all facing an existential crisis, and the faster we become aware, not only of the crisis, but how do we mitigate this crisis, because a solution exists, but the window is fast closing. I think if we don't move to the pathway of now 2 degrees above the pre-industrial levels, because I think the 1.5 is already lost. So thank you. Those are very, very interesting points. Chandru, now if we could come to you on the ratings question, and I think, it'll be very interesting getting your perspectives, because you have been, in your former incarnation, you were involved with the whole ratings and rankings process at MSCI, and now you are a practitioner. So tell us the difference between, the real experience and, what would you do? Where do you think we need to go on ratings and rankings?
Sure. No, thank you for the question. In fact, I was waiting for that. I've not only been with MSCI, but also with CRISIL. So 2 ratings, so ESG ratings as well as credit ratings. And I've seen actually both of these things in close quarters. So I would say that, it is true that ESG ratings are not always, and I wish to stress the word always, uniform. ESG ratings are often compared to credit ratings. And I would like to say that it is unfair to compare both, as ESG ratings is a relatively young science when compared to credit ratings. As ESG ratings become more mandatory like credit ratings, I think the standardization of the evaluation would probably become more uniform. And it can and should never be 100% uniform, because if it becomes, then it doesn't provide so much value. But it should not be too much divergent to each other. So I think that is this one. So I think it's an evolving science. And from an investor's perspective though, ESG ratings on structured data or ESG inferences from unstructured data using machine language and artificial intelligence provide valuable information and insights. There should not be a complete reliance or a cure pill approach, whether to ESG ratings or to credit ratings. And I think, all agencies make it very clear that, there should not be a complete reliance on that. I think but the issue is across the world, people take that as an easy approach.
Yes.
to shoulder all the burden on the rating agencies, which should not be, I think, which is a lazy way of actually, as they say, there used to be a lazy banking and everything. It's not the right way of actually looking at it. And I would say that, they should not be, where such ratings are available, these should be taken as a kind of starting point and overlaid with human analysis and wisdom to infer the data for decision making. Because there's always a value which human beings actually bring in. And I don't think, any bit of, any stretch of artificial intelligence can still replace humans. Otherwise, we would probably be in the matrix. That is one point, which I wanted to emphasize. Now, there is a move in Europe to provide a better regulatory oversight to ESG ratings, similar to credit ratings. And I think that should bring in better comparability, between different ESG rating agencies, whether it's MSCI or, other agencies which are there. And transparency is always welcome. And all ESG ratings providers have been increasing their transparency of how such ratings are done to the extent their IP is not compromised. And anyone can visit the website of these agencies to check the disclosures and the methodology. And regulations may drive more disclosures, but at the same time, regulations have to ensure that they do not force IP disclosures, and they should foster more innovation and competition in ESG ratings, and as well as, all other kind of service providers who are coming in. And I know for sure that there is plenty of action happening on that front, whether on supply chain or on, for small and medium enterprises, disclosures, and all this kind of thing. So there is a plenty of action actually happening in India, and people are raring to go. I think, it just requires a little bit of more spark and, ignition somewhere to actually push all these things. I hope that helps. Thank you.
That does. Thank you. Let me now, move over to Shashwat, on this issue. And it would be nice if you could provide some, further clarity. So there are two key questions that, you could probably shed light on. One, is there a case for a legally binding definition of ESG ratings, given the lack of comparability between data providers? So clearly, we've seen that there is one company, but you have two diverse set of ratings on that one company, which confuses a lot of asset managers. And the other question is there a need for more transparency on the methodologies that underlie these ESG scores? So what are your views on that?
So is there a need for a unified legally binding framework? I think yes. Can we rely on the government completely to do it? Probably not. It will require all stakeholders from industry, practitioners, maybe even academia to put that together. I think that would be very, very useful. So if we think about these ratings or rankings, we can think along three dimensions. One is the scope. What is it that it constitutes environment, social, and governance? And so there is a recent paper from folks at academics at MIT that looks at exactly this. Why is there a divergence? Thankfully, on scope, there is not much divergence. So all rating agencies sort of care about environment, social, and governance. In terms of measurement, there is more divergence, especially when it comes to measuring environmental and social factors. On governance, there is more or less uniformity. Should the ratings be more transparent? More transparency is always good. But when it comes to ESG, the ratings are already reasonably transparent. In other words, you can try and back out what factors are these firms being rated on, and to a reasonable degree. What varies a lot is measurement and the weight that different agencies provide on each parameter. And I would suggest that we do away with the weights completely, because that brings in subjectivity. Just report the individual parameter rankings across multiple dimensions. And as Chandru very, very rightly pointed out, ultimately, this is not all quantifiable. ESG can be quantified, but at the same time, it needs to be assessed. It's sort of like when we are hiring a person, we can measure expertise, but we can only assess collegiality. So that human effort to assess what is the environmental impact a particular company is having has to go beyond the quantitative measures that any agency would mandate. So yes, I mean, in short, yes, I think there is a case to be made, but it requires careful thought from all stakeholders, and it cannot be just a one-shot top-down approach from the government regulators forcing all firms to disclose. Let's start with the top companies. The larger, it's easier for the larger companies to do it. I'll just make a second point on alpha because it was brought up earlier. I don't mean to intend to say that ESG cannot be profitable. You can pursue both profit and purpose at the same time. There is a lot of evidence in the literature, academic literature, which shows that the stock price actually goes up when you follow good ESG practices. So the cost of capital comes down. What I meant, as an investor, if I am willing to pay a higher price for a company that is more environmentally conscious, because I am getting in at higher price, the future returns may not be as high. And that shows up in the data as well. In large sample evidence, ESG funds don't perform non-ESG funds. They may outperform the benchmark, and which is fine. My humble submission here is, as a society, we should be willing to compromise. We need not have to, but we should be willing to compromise on financial returns. On ESG itself, so if you look around the world, it's the developed countries which are doing better or push when it comes to driving the ESG agenda. Within countries also, if you look at firms, it's the larger and more profitable firms that are driving the ESG agenda. So one and two, both of them have to coexist. If you make more profit, maybe you can drive more ESG as well. And that point is fair. So we need money to be able to do this. We need hundreds of millions of dollars.
Thank you. Thank you. Very, very interesting again. I think in the interests of time, we have, I have one more question, and I'm going to put each one of you in a spot over here because we do need to go on to a Q&A. And now I'm going to put a question to you, all of you, and we literally have 1 minute per participant. This question is, and I think each one of you is going to answer differently. To Satya, I will say, what is or what are the 2 to 3 things that you would recommend the Modi administration do on, climate change mitigation? So that's a question to Satya. And I think similarly, I think a question to each of you, to Chandru, the question would be, what would be the 2 to 3 things that you would want SEBI to do? Is it on the disclosures, on the BRSR norms? What would you want them to do? Niranjan, the question would be, what would you like the Reserve Bank of India to do? Are there some practices? We've seen what the Bank of England has done in terms of addressing climate risks. So what would you want the Reserve Bank of India to do? And to you, Shashwat, I think the question would be, what would you want the Chartered Accountants Institute to do, the ICAI to do? And also, what would you tell your dean at the International School of Business on how to make each and every one of your students aware of the many risks and the existential risks that Satya, so rightly alluded to? So Satya, we'll start with you. And I think each one of you, we have literally 1 minute per participant.
Thank you. Thank you, Abhay. So very quickly, 3 things, let's say 4 things. The first is that the government really needs to become an enabler, a facilitator, by identifying ideas with the potential for system scale transformation. And from my own knowledge, I can tell you, there are hundreds of them out there in India with serious potential to change the trajectory of climate change. Identify the ideas, find the champions that are either already pushing these ideas or have the potential to latch onto these ideas and do something bigger. Find the financing mechanisms to projectize these ideas and get them implemented on mission mode. Then document success and replicate. That's what we need to get to $1 trillion of investment in India in the next 10 years. That will be the mother of all such engagements, but then will help India come out on top of both the climate engagement, the climate challenge, and become a climate champion globally.
Thank you. Thank you. I do hope that someone from the administration is listening. Chandru, over to you. What would you ask SEBI to do? What would be the 1, 2, 3 things, all in 1 minute?
Yes, Abhay. I think as far as SEBI is concerned, I think they've been quite proactive in actually bringing out regulations.
Yes.
The PRS are extending it from the initial set of companies to 1,000. And there are actually quite a few other regulations on governance, or rather, a lot of regulations on governance. I think what is required more by either SEBI or most regulators is more than the regulations themselves. I think the enforcement of these and making an example of companies is very essential, because then only actually, everyone knows that, these will be enforced. I think that's a number one point, I would actually like to mention. But let me also say that, regulations do play an important role, but market mechanisms are more powerful as they go beyond what is mandatory and set apart the best corporates and makes them leaders. So I think, it has to move beyond regulations. And that's where, the institutional investors play a very, very, institutional as well as retail investors play a fantastic role, either actually through the asset management companies or through proxy advisors. So I think, it goes much beyond regulations. But as I said, these are something, which is required. The enforcement part is something, which will be key to make companies, come online. But, even from the investor side, I would say that they have to be more active and also either do direct stewardship or engage external specialized stewardship firms, which do not have any conflict of interest, to take care of their interest and take an active engagement approach with corporate firms over a period of, say, 3 to 4 years. Because this has to, as Niranjan rightly pointed out in the beginning, this is a cultural change, and it has to get into the DNA of the organization. It doesn't happen overnight. So I think, that's where the trend has to actually move. And just a last point from my side, I think, I would say that we have spoken a lot about climate change, the risk and opportunities. These are very specialized, and that is still very nascent in India. And that's very much required. And EU taxonomy norms provide a necessary framework for categorizing the climate change adaptation and mitigation investments, while TCFD provides a good framework for reporting and analyzing the climate change related risks and disclosures.
Indeed,
So
indeed. So on the TCFD, before I go to the others, on the TCFD, the government of India has not yet embraced the TCFD. So do you think there is a way around it, until the government accepts it? Should other stakeholders go out and voluntarily embrace the TCFD disclosures? So this is a very, very quick answer to this would be very useful.
Yeah, no, I think there are many other things which the government does not adopt or take over. For example, the GRI or the integrated reporting is not mandatory. But these are driven by actually, again, a selfish motive of companies to understand the climate risk and opportunities. And that's where I think, this thing should be adopted by companies voluntarily. There is no need for the government to enforce it at all.
Very true. Very good.
Taxonomy norm, I think, there is a lot of discussion, and I'm part of one of the panels, UK-India committees, where we are talking about taxonomy. There could be differences between the EU taxonomy and what India probably needs to adopt, but there has to be a taxonomy norm also coming.
Yeah. Good. No, that will be, I think the EU taxonomy will be very, very useful once it comes out, and I'm sure the whole world is going to probably embrace that. Thank you. Let me now have, Shashwat, you answer the question. What would you want the Chartered Accountants Institute to do, and what would you advise your dean to do to make it each and every student climate aware and ESG aware in 1 minute?
So first, what would I want the Chartered Accountants to do? Maybe support, and even the government support initiatives like which I wasn't aware of, the Climate Finance Institute, which is being brought up. I think we need a lot more research in this area, especially for emerging markets. So if you look at TCFD or the SEC framework for climate reporting, all of them say that firms need to disclose what is the value at risk because of climate risk. What they don't tell the firms is, how do you measure climate risk? And this varies across industries, across firms, across geographies. I have been trying to work on this with a colleague. It's very difficult to assess climate risk, even for somebody who's doing it day in and day out. So maybe they can try to come up with a metric for at least some set of firms which measures climate risk and assesses the financial impact of that on those firms. That will be a starting point. At the very minimum, we need that, because right now the firms may not know how to measure that. To our dean, I think again, more support for research on this, more funding for faculty members, but we already are introducing courses on responsible business, which brings in studies on the impact of ESG norms, maybe a more push towards these kinds of courses and more interaction with industry on how they can be engaged and how ISB could contribute in making India more ESG ready. That's it.
Very interesting, very interesting. And Niranjan, your views, what would be your advice? What would be your recommendations to the Reserve Bank of India? What should they be doing, particularly on climate risk?
So I think this point also kind of was mentioned by Chandru in terms of SEBI, but clearly mandate on assessing environment, climate risk, and also disclosing, right? I think that's something, because banks being such an important conduit to the whole money flow, I think we are in a position to influence outcomes of a significant part of the community, right? And like investors, I think we can, if there is a mandate that is given to the banking sector to kind of start measuring and start disclosing and talking about this, it automatically gets enforced into eventually the community at large. So I think clearly, whether it is TCFD or getting into the network for greening the financial system, which is the NGFS, I think RBI can actually come out with some hardcore regulations on environment and climate. The second is clearly, if you look at RBI regulations, there is a reasonable sponsorship for the S, which is the social, through the PSL norms, priority sector. What RBI can definitely look to do is that on one end, they kind of mandate stricter regulations, but at the same time also incentivize financing for climate by expanding the scope and definitions of PSL. So I think that's the second area. The third clearly is from a capacity building standpoint, where they have the CAFRAL Institute. We discussed about other institutes as well. But clearly, how can you train the banking sector also for the emerging risk and create the capacity for the sector being instrumental in driving the ESG agenda?
Right. Very interesting. Very interesting. I do hope that some of these recommendations can indeed be sent out to each of the stakeholders. And I think honestly, India really needs to have a lot of debate, because as I said earlier, and I think all of you have alluded to, India will have to hit the ground running. And many comments from Satya have illustrated how significant the existential risks are, and particularly for a country like India, which is amongst the top 5 climate vulnerable countries. Let us now move to some questions. There are some very interesting questions that have come for the panelists. Let's start off with the first one, and I think we have time to take about 2 to 3. And I think this question is very relevant from a decarbonization perspective. The question is, what measures would you expect from the regulators in terms of power and cement emissions, which have the highest share in the total emission for any country, including India? In terms of portfolio management, it looks difficult to see power and cement production without coal, because the share of renewables will take decades to rise significantly. How, therefore, would you see these in ESG portfolios? I think, Chandru, can you take a shot at this question, please?
Yeah, definitely. Thank you, Abhay. I think, again, one is from the regulatory side, again, from the market side. I think, there is a push, especially from there is a lot of push from the regulators to wean away the heavy energy using industries like cement and steel away from using fossil fuels. And I think Yogesh is right in mentioning that, the renewable energy may not take actually all the load. But the point is, there has to be a beginning which is to be made. And, the EU taxonomy actually, takes out fossil fuels from the equation completely in that. There is, of course, the question of stranded assets which are actually coming in, and how do you actually do that? And that's where just transition actually comes in. And there is a talk about just transition bonds and everything, which is also actually happening. The point is not also about, whether, and when we should take out fossil fuels from the equation, because if we do not do that, what we have seen in the recent past in places like Uttaranchal or Uttarakhand will actually probably accelerate. And, with the contribution of actually fossil fuel and heavy industries using fossil fuel, this is only going to actually threaten our livelihoods and our, sustainability more and more. So definitely, it is not the question of, whether we should do it, how much we should do it. There is a beginning which is to be made and which is already made. And I know for sure, I know actually I've been monitoring a lot of large companies which are in the power sector and in the coal and steel. They've been steadily moving out of this and increasing their renewable energy share. And there is a lot happening in the renewable energy segment itself. And India has taken a lead in solar energy. And I think India's nationally defined contributions do actually mention about how we will be steadily moving into that. So nothing happens overnight. And I think there is a lot of action happening on that front.
Thank you, Chandru. And if I may add, I think we really need to see decarbonization as the 21st century's biggest opportunity. According to the Energy Transitions Commission, decarbonization will entail a total investment of close to $100 trillion over the next 30 years. So I guess if we really see decarbonization as an opportunity rather than an expense, I think we'll probably be able to find, mitigations to climate change, because this will be a business opportunity. We should not see climate change as a risk, but we should see climate change as one of the biggest commercial opportunities, i.e. decarbonization of this century. Moving on, I think there is one question, and I think this is for Shashwat Alok. Is the ISB doing any research on how to measure impact in a way that's integrated with financial returns?
So we are trying to, that was the question that we were trying to address in this paper, looking at ESG versus non-ESG mutual funds, on trying to assess the non-financial return aspects, and do investors respond to it. Now the difficulty is, because it's non-financial, it's difficult to quantify, so that will take a while for us to figure out, but yeah, we are thinking about it for sure.
Sure, thank you. This is a question for Satya, and I'm reading the question. You said that one can't defy the laws of physics. So what, according to you, is the fate of India, given the required need for alignment between sustainability and the growth trajectory?
I think the future of India is bright. And let me tell you why, on something that I've been deeply involved in. There are a lot of very substantial studies that are telling us that we are roughly 50 harvests away from not growing any food any meaningfully to feed the 10 billion population that will be on the planet by 2050. But there are examples in India. And also to mention a little metric here, a few numbers. If you take the global, and I'm talking global numbers here, steel industry, IT and IT-enabled services, and automotive sector and their ancillaries. So if you take all these three, and these are industry numbers I'm quoting, it's about 35 million jobs worldwide. If you take smallholder farmers, there are 500 million smallholder farmers around the world. If you take them as entrepreneurs, these are serious entrepreneurs. The risk frontier at which they work is unbelievable, because they survive from one crop cycle to another crop cycle. And let me bring you back to India. We're talking about growth and sustainability going together. Andhra Pradesh started something a few years ago. They call it community managed natural farming. As of, I was actually meeting with the Chief Minister on Monday to compliment him on the outstanding work his government is doing. They have converted 700,000 farmers already to zero synthetic chemical farming. That's not small. So these are half literate or illiterate farmers that have actually spent the last 30, 40 years doing synthetic chemical farming, and they are willing to change behavior. There's hope for this country. It's we who need to change behavior, the so-called intelligent people that don't see the reality even when it stares us on our face. And what is happening in Andhra Pradesh? A bit of a national story and an international story. They have inspired the country so much with their work that the Prime Minister announced in an international conference that he would like India to do zero budget natural farming across the country.
Yes.
Several other states, Himachal recently announced that they would like to go completely natural farming in the next few years. Now, what does it do? India has 120 million smallholder farmers. The Andhra Pradesh example shows us that the input costs drop by as much as 80% because they don't use synthetic chemical fertilizers or pesticides anymore. And they also don't use compost as much as organic farming needs. It's a process of bioinoculation. So that's what it is, costs very little. And the yield has increased in most crops by 28%, but in some crops like millets and all the so-called superfood by almost 200%. So it's changing lives of people and spawning an ecosystem of healthy agricultural produces that will make us a healthier community while making the bottom of the pyramid stronger. The stronger the foundation, the better the pyramid of growth and opportunity. And if you take that, and it also, the interesting part there is, and you know, it sounds ludicrous, that currently we spend, I'm talking about Andhra Pradesh, 4,000 crores on fertilizer subsidies. You'll save that. About 8,000 crores on farm electricity subsidies, and this form of agriculture actually saves 50% water. We've documented it already. And the total cost of conversion, capacity building, training the farmers and hand holding and all is about roughly 15,000 crores. So just in 2 years of what you put as subsidies, you could actually do, so it'll be cost neutral to the government. And you can actually, and the international story, and this is fascinating. KfW, the German Development Bank, which had hardly ever put any money on agriculture because it's very risky and they don't do that. They have put $300 million now into this community managed natural farming at a coupon of 50 basis points. Unbelievable. Even the World Bank doesn't lend you money at those rates. And they have put that money on half-literate farmers, hoping that this is the next frontier that will change Andhra Pradesh and change India. So we have it within, among ourselves, we have people that really care about Mother Earth. And so growth can indeed go with sustainability. We just need to see the opportunity for what it is and believe in ourselves to make that difference. Nobody is going to come from outside to inspire us. We have to inspire ourselves and thereby inspire others to believe in us. Thank you.
Thank you, Satya. Thank you. We have two more questions. The first one will be to Niranjan. This question says, what are some of the biggest barriers for implementing ESG for corporates?
One is, I think the first and foremost is the understanding of what ESG is and what consequences it has, right? If there are no deterrents that corporates face in conducting their business, clearly it's something which will not be appreciated as a point, right? And to the point that Mr. Tripathi also mentioned. So, for example, it's individual companies. They will have to see what their business plans are going to be over the next 5 to 10 years. What is environment, climate kind of impacting them? So we've seen enough cases where if you look at market cap of Ford Industries 10 years back and let's say Tesla versus what the market cap today is, we clearly have, you might have cases that companies, if they don't move towards EV automobile, at some stage would be out of business, right? And I think these are things that the understanding and the recognition, acknowledgement that this is where, this is a real risk which is hitting us is something that needs to come. Many a times, because maybe investors did not ask enough questions, maybe because banks did not kind of create enough hurdles, it kind of appears that maybe ESG is still not that important question. That's the reason we are having this panel discussion to say how we all can come together and each one play its part in determining the course for it. So I think it's the acknowledgement it is a real risk, and then driving it top down through an absolute cultural shift, which has to be driven by the board and the CEO. I think that's in my view are the two most important factors which will work or which will not work for companies to adopt ESG.
Thank you, Niranjan. Thank you. I think in the interest of time, we will take one more question. And this question is from Frederick Fremberg. And I think I'll direct this question to Chandru. The question is, how do you view the need for ESG and sustainable reporting tool targeting SMEs in India? And if needed, what will be the main driver for that? Chandru, over to you.
Thank you. Thank you, Abhay. I think, there is definitely a need for ESG and sustainable reporting, tool and targeting SMEs because, it has to seep down. And these are not only for actually listed, but also for private and unlisted SMEs. But the essential thing would be that the tool should not be very expensive so that, everybody can adopt this. And the main driver there would be actually the purchasing companies, I would say. The larger companies which are actually purchasing from them, they also need to do a lot of reporting. And I think a tool like that, which is not extremely expensive, will definitely facilitate that. So the drivers have to come from there.
Very good, very good. I think this is going very well. And if I may, with the permission of the panelists, ask one more question, because I think this is, again, I think very, very relevant, particularly coming from an ESG investing perspective. This question can be answered by, any of you, but I'll, direct it to Shashwat. The question comes from Durga Shankar. He asks, there are many ESG investment products coming up lately in India. What could be a good way to compare them on ESG credentials?
So that's a tough question for me to be able to answer. The good way would be if the funds that are declaring themselves as ESG could transparently communicate what are the parameters based on which these firms were put into the portfolio. And what do we mean by ESG in the context of special funds? It's difficult for me to comment. So I think more transparency from the funds themselves. And it seems to me that the financial industry is quite concerned about this. So maybe they are the ones who could be leading in making the consumer more aware about what the ESG portfolio constitutes and how it creates larger societal and financial impact.
Very true. I think that's a very good answer because, internationally, there has been, some criticism that as a result of the desire to invest in ESG products, many global ESG funds were having greenwashing. So, Chandru, I think, would you like to answer this? Maybe this is absolutely the last question and absolutely the last answer. But Chandru, could you answer this?
Could you actually paraphrase the question again, Abhay?
Sure. There are many ESG investment products coming up lately. Right. What could be a good way to compare them on ESG credentials?
Okay. I think, see, if I understand the question correctly, this is more about actually mutual funds.
Yes, yes.
Actually different ESG funds and everything.
Yes.
It is actually, when we are seeing, how needs to be compared, it's still early days. There is not enough data, and the comparison would probably go with the, we need to delve a little bit more inside as to what kind of methodologies they are using. And again, as I alluded to in the beginning, it shouldn't be a cure pill approach of saying that, we are just purely going by the ratings of actually any kind of agencies. So what is the value add which is being done by the fund manager? And what is the approach they are taking, whether they're taking a passive approach or they're taking an active engagement or an active approach, I think becomes important. That's where the value add would actually come. And that, I think, is the questions which needs to be asked and need to be compared.
I think very, very well answered. I would agree that, there is a lot of onus on the asset managers to really define what they mean by ESG, because I have seen a lot of ESG products which do invest in fossil fuels. And honestly, for a country like India, where climate awareness and decarbonization are such critical requirements, I would think that ESG funds that invest in fossil fuels and deep carbon industries must be making full disclosure of their views on the carbon footprint. As I said, this is absolutely the last question, and this is absolutely the last answer. I would like to thank all our participants today and all our panelists for providing so many insights on a subject that really requires a lot of attention in India. Some very, very good insights made. And I do hope that Buzz on Feed can continue with this dialogue and have more narratives around this very important theme. Thank you very much.